What if I told you that thousands of retirees across America are losing hundreds, sometimes thousands, of dollars every single year? Not because they made bad investments, not because the stock market crashed, but simply because they didn't know a few basic IRS rules. And the scary part? Most of them don't even find out until it's too late. Stay with me, because in the next few minutes, I'm going to make sure that never happens to you. Welcome to Frank Join Financial, the channel where we break down complicated money stuff into plain, simple English so you can make smarter decisions, protect what you've worked for, and actually enjoy your retirement. If you're new here, hit that subscribe button right now because we put out videos every week that are designed specifically for people like you, everyday Americans, who want to take control of their financial future. Today, we're talking about 10 IRS rules that every retiree absolutely must know the moment they stop working. Whether you just retired, you're about to retire, or you're helping a parent or loved one through this transition, this video could save you a serious amount of money. Let's get into it. Let's start with rule number 1, and this one catches so many people off guard. It's called Required Minimum Distributions, or RMDs. Now, I know that sounds technical, but stay with me. This is actually very simple once you understand it. When you have money sitting in a traditional IRA or a 401k, the IRS has been very patient. They let you grow that money for decades without taxing it. But the moment you hit age 73, they say, okay, it's time to start paying up. The government requires you to take out a minimum amount from those accounts every single year. And if you forget to do it, or you take out less than you're supposed to, they hit you with a penalty of up to 25% of the amount you should have withdrawn. That's not a typo, 25%. So imagine you were supposed to take out $10,000 and you forgot. You could owe the IRS up to $2,500 just in penalties. The fix is simple. Know your RMD deadline, which is usually December 31st of each year, and make sure you're taking out the correct amount. Your financial institution can help you calculate this, or you can use the IRS's own worksheets on their website. Rule number 2 is one that surprises almost every new retiree. It's the fact that Social Security benefits can be taxed. Yes, you read that right. A lot of people assume Social Security is completely tax-free income. But here's the truth. If your total income in retirement crosses a certain threshold, up to 85% of your Social Security benefits can become taxable. Here's how it works. The IRS looks at something called your combined income, which is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. If that number is between $25,000 and $34,000 for a single filer, up to 50% of your benefits could be taxed. If it goes above $34,000, that number jumps to 85%. For married couples filing jointly, those thresholds are $32,000 and $44,000. So, if you're planning to pull money from retirement accounts and collect Social Security at the same time, you need to be very intentional about how much you withdraw each year, because you could accidentally push yourself into a higher tax bracket. This is why planning matters so much in retirement. Let's talk about rule number 3. And this one is actually good news. Once you turn 65, the IRS gives you a higher standard deduction. In 2024, the standard deduction for a single filer over 65 is $14,950. For married couples who are both over 65, it jumps even higher. What does this mean for you? It means you might be able to reduce your taxable income significantly just by taking advantage of this deduction. And you don't have to do anything complicated to get it. It's automatic when you file your taxes. A lot of retirees don't realize this and end up paying more taxes than they need to. So make sure your tax preparer knows your age and double check that this deduction is being applied correctly. Now, rule number 4 is one that trips people up because it seems like such a small thing, but the consequences can be big. This rule is about estimated quarterly taxes. Here's the deal. When you were working, your employer automatically withheld taxes from your paycheck. But in retirement, if you're getting income from a pension, withdrawals from your IRA, rental income, or investment dividends, nobody is automatically withholding taxes for you. So the IRS expects you to pay your taxes throughout the year in 4 quarterly payments. These payments are due in April, June, September, and January. If you don't make these payments and you end up owing more than $1,000 in taxes at the end of the year, the IRS can charge you an underpayment penalty on top of what you already owe. The good news is you can ask the IRS to withhold taxes directly from your Social Security payments, or you can set up automatic payments. The key is to plan ahead so you're not hit with a surprise bill come tax time. Let me tell you a quick story about a man I'll call Robert. Robert retired at 66 after working as a school administrator for 35 years. He had a nice pension, some IRA savings, and was collecting Social Security. He figured since he was retired, he didn't have to worry about taxes the same way anymore. So he just waited until April to file, like he always did. But by then, he owed the IRS over $4,000, and he had an additional underpayment penalty. He had no idea that was even possible. He told me it felt like getting a parking ticket in your own driveway. The lesson here is simple. Just because you're retired doesn't mean the IRS stops watching. If anything, you need to be more aware, not less. Rule number 5 is about Roth IRA conversions. And this is a strategy more retirees should know about. A Roth IRA is a retirement account where you contribute money you've already paid taxes on. The big benefit is that when you take money out in retirement, it's completely tax-free. And Roth IRAs don't have required minimum distributions like traditional IRAs do. Now, here's the IRS rule to know. If you convert money from a traditional IRA to a Roth IRA, you will owe taxes on the amount you convert in that year. But many financial advisors recommend doing small conversions in the early years of retirement, especially if your income is temporarily lower. Why? Because you can move money into a tax-free account now, and then later on, that money grows without any tax consequences. It's like planting a tree in the right soil. The IRS has specific rules around how this is taxed, and when you can start withdrawing without penalty, so make sure you talk to a tax professional before making this move. Rule number 6 is one of the most overlooked rules in all of retirement planning, and it's about Medicare and its connection to your income taxes. Here's what most people don't know. Medicare Part B and Part D premiums are not one size fits all. The amount you pay depends on your income. This is called IRMA, Income-Related Monthly Adjustment Amount. If your income is above a certain level, you'll pay significantly more for Medicare. For 2024, if your individual income is above $97,000 or your joint income is above $194,000, you start paying higher premiums. Now, why is this an IRS rule? Because the income they look at is from your tax return, specifically from 2 years ago. So if you had a one-time high income year, say from selling a property or doing a big Roth conversion, that could bump up your Medicare premiums 2 years later. Being aware of this connection between your tax return and your Medicare costs is crucial. We're halfway through, and I want to make sure you're sticking with me, because the next few rules are the ones that could make the biggest difference in how much money you actually keep in retirement. Let's keep going. Rule number 7 is about what happens when you give money to family or charity in retirement. A lot of retirees want to help their kids or grandkids or donate to a cause they care about. The IRS has a rule called the annual gift tax exclusion. In 2024, you can give up to $18,000 per person per year without any gift tax implications. So if you want to give your 3 grandchildren money, you and your spouse together could give each of them $36,000 per year, completely tax-free. Now, if you go above that amount, you don't necessarily owe taxes right away, but you do have to file a gift tax return. Understanding this rule helps you be generous without accidentally creating a tax problem for yourself or your family. Rule number 8 is about what's called a qualified charitable distribution, or QCD. This is a fantastic strategy for retirees who are charitably inclined. If you are 70 and a half or older, you can donate up to $100,000 directly from your IRA to a qualified charity, and that money counts toward your required minimum distribution. But it does not count as taxable income. Let me say that again because it's that good. You take money out of your IRA, it satisfies your RMD requirement, and you don't pay any taxes on it. Regular people who donate to charity can only deduct charitable contributions if they itemize their deductions. But a QCD works even if you take the standard deduction. If you're giving to your church, a food bank, a scholarship fund, talk to your financial advisor about setting up a QCD. It's one of the most powerful tax-saving tools available to retirees that most people have never heard of. Rule number 9 is about keeping good records. And yes, the IRS absolutely cares about this. In retirement, you may be drawing from multiple sources: Social Security, IRA withdrawals, pension payments, part-time work, rental properties. Each one of these has different tax treatment. And if the IRS ever audits you, you need to be able to show documentation for every single dollar. Keep records of your RMD calculations and withdrawals. Keep records of your Roth conversion paperwork. Keep records of charitable donations, especially if you're doing QCDs. Keep any statements showing the cost basis of investments you sell. The IRS typically has 3 years to audit you from the date you file, but in some cases, especially if income was significantly underreported, that window can stretch to 6 years or even longer. Good record keeping isn't just about being organized, it's about protecting yourself. And that brings us to rule number 10, which might be the most important one of all. This rule is simply this: taxes don't stop when work stops. A lot of retirees make the mistake of thinking that once they leave the workforce, their tax situation becomes simple. But for most people, retirement is actually when tax planning becomes more complex, not less. You now have multiple income streams, each with different tax rules. You have deadlines for RMDs. You have Medicare premiums tied to your tax return. You have potential Social Security taxation. You have estate and gifting considerations. All of these things interact with each other, and making one decision without thinking about the others can cost you real money. This is why having a tax-aware retirement plan, not just an investment plan, is so critical. A good CPA or financial advisor who specializes in retirement can help you see the full picture and make sure every dollar is working as hard as possible for you. So let's bring it all together. Here's a quick summary of everything we covered today. The IRS requires you to take required minimum distributions starting at age 73 or face major penalties. Social Security can be taxed depending on your total income, so plan your withdrawals carefully. Retirees over 65 get a higher standard deduction. Make sure you're using it. Pay estimated quarterly taxes if you have income without automatic withholding. Consider small Roth IRA conversions in low income years to reduce future taxes. Watch how your income affects your Medicare premiums through IRMA. Use the annual gift tax exclusion to give generously without a tax headache. Use qualified charitable distributions if you're charitably inclined and want a powerful tax break. Keep meticulous records of all retirement-related financial activity. And remember, tax planning in retirement is not a one-time event. It's an ongoing strategy that requires attention every single year. Here's what I want you to do right now. Take a piece of paper, yes, an actual piece of paper, and write down 2 or 3 of these rules that you weren't already aware of. Then make a commitment to look into them more deeply this week. Share this video with a friend or family member who is retired or close to retirement. You could literally be saving them thousands of dollars just by hitting that share button. And if you found this video helpful, please give it a thumbs up. It tells YouTube that this content is valuable, and it helps us reach more people who need this information. If you're not subscribed yet, please subscribe and hit the bell icon so you never miss a video. We release new content every week covering topics like Social Security strategies, retirement tax planning, investing in your 60s and beyond, and so much more. I'd also love to hear from you in the comments below. Which of these 10 rules surprised you the most? Or is there a retirement tax question you've been wanting answered? Drop it in the comments, and I might turn it into a future video. This is a community, and your questions help shape what we cover here. Thank you so much for watching Frank Join Financial. I'm here to help you protect your money, stretch every dollar, and enjoy the retirement you worked so hard to earn. I'll see you in the next one.